Okay, hello everyone, and welcome to SIEPR. It's great to have you with us here today, and we're all in store, I think, for a really interesting and insightful discussion with Rob Kaplan. We actually had an event with about 25 students, a small intimate event upstairs a little while ago, which was a lot of fun and made it clear to me that I need to bring a lot of adrenaline to this event because I was feeling a bit. Anyway, you'll see soon enough. So as the CEO of the Federal Reserve Bank of Dallas, Rob is on the front lines of many of the issues and economic policies that we are studying here at SIEPR. The Dallas Fed is in place to foster and promote financial stability in its region, which includes all of Texas and, interestingly, also northern Louisiana, correct me if I'm wrong on this, and southern New Mexico. And so we're going to hear a bit about that region here today. He's in constant touch with business leaders throughout those areas, so he knows better than most, perhaps more than anyone, and much faster than most, how policies are impacting the economy there. In the past few weeks, he's been learning also about how things outside the policy world affect the regional and national economies, most notably, in his case, with Hurricane Harvey hitting Texas in late August. Before that, the state's economy was growing at a strong pace. This did slow things down a bit there, and so that's a big part of what we saw last week with the jobs report, the first time nationally that we've seen a reduction in the number of jobs in the U.S. in more than 7 years. And we're going to hear a bit about Hurricane Harvey, I hope, today. I do think that he expects Texas to rebound from the storm because it's been growing so strongly, and I'm interested to hear about what's been happening there. Another area that he's been focusing on, and we'll hear a bit about, is technology-enabled disruption, which here in Silicon Valley we know a fair amount about. Instances where technology is being used to change business models by creating lower prices, giving consumers more choices, and changing the nature of competition, which is affecting the labor force and inflation and many other things. And of course, you can't talk about Texas without also talking about oil and energy. And so we'll hear a bit about that today and what's happening in the global markets for oil supply and demand. As a member of the Federal Open Market Committee, Rob is also really has his finger on the pulse of national monetary policy. So we'll talk a bit also about interest rates and maybe a bit about what we can expect in the, not necessarily tomorrow, but in the months ahead from the central bank. Rob has been president and CEO of the Dallas Fed since September of 2015, where he oversees 1,200 employees, which is tiring to me to think about because SIEPR seems big, and I think like we've got about 30, and so that seems like a big. But you were at Harvard Business School, so maybe they taught you how to manage that there. But it is before joining the Fed, he was on the faculty and was a senior associate dean at Harvard Business School, and he's written several books. One especially caught my eye as one that I really want to read, which is What You Are Really Meant to Do, a Roadmap for Reaching Your Unique Potential. So I'm planning to track down that book soon. Yeah, that would be great. I would love to read it. Before joining Harvard in 2006, Rob was vice chairman of the Goldman Sachs Group, where he was in charge of the firm's investment banking and investment management divisions. And before that, he served as the global co-head of the investment banking division. I can't do justice. He's got many, 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 many accomplishments. He became a partner at Goldman in 1990, held several other roles during his 23 years at the firm, and he serves as chairman of Project ALS and co-chairman of the Draper Richards Kaplan Foundation, a global venture philanthropy firm. And I think you are also still on the board of Harvard.
Bill Draper will be here tonight.
And Bill Draper will be here tonight. Wonderful. And he's also a board member of Harvard Medical School and has served on the boards of State Street, Harvard Management Company, Bed Bath & Beyond, and Heidrick & Struggles. Also a trustee of the Ford Foundation, so it goes on and on. But it all started for Rob actually in Kansas. He grew up in a place called Prairie Village and went on to receive his Bachelor's of Science in Business Administration from the University of Kansas, and then on to Harvard for an MBA. Today, he is with us at Stanford, so please join me in extending a very warm welcome to Rob Kaplan. So. And today we're going to do things a bit differently. We're going to basically have a discussion where instead of his presenting right at the outset, it's going to be me lobbing some questions his way. And we'll open it up for questions from all of you in a little while. But why don't we start off by talking about the region of the country that you're most concerned with today, which is Texas and I guess that part of the world, and a little bit about the hurricane too, perhaps.
Okay. All right. Thanks, Mark. And thank you all for being here. It's great. It's great to be here. So bless you. And so let me just make a comment about the hurricane, because many of you have asked me what the impact is, and it's interesting. And at the Dallas Fed, you can imagine we've done a crash course on studying other storms, and we've had other hurricanes in the past. And here's what we have found, and here's what we believe will happen. And this is also true of Irma and so on. Harvey hit the Gulf Coast of Texas. It is our judgment that the impact of Harvey will be a reduction in jobs, job growth and GDP in the third quarter of this year. That'll affect Texas, it'll affect Houston, it'll affect the United States. But interestingly, and this has been the pattern of other storms, we expect the fourth quarter to more than catch up. And so actually our job growth forecast for the state of Texas pre-storm was 2.5% job growth. Our estimate right now is 2.6% job growth. As it relates to the United States, you might be wondering what's the impact of these recent hurricanes. Interestingly, similar. Weakness in the third quarter, rebound in the fourth quarter. We will catch up. And then we will resume trend growth. And that's been the history of these other storms. Kind of interesting and surprising. In terms of Harvey, for those who wonder, we believe the net impact is about 75 to 100 billion of damage. 45 to 55 of that 75 to 100 is home damage. About 10 to 12 billion is auto damage. About 15 to 20 billion is commercial damage. And then there's some other categories. Unfortunately, a substantial percentage of those losses will ultimately prove to be uninsured. So unlike Florida, where people are more apt, given the history, to buy insurance, hurricane insurance, our estimate is about 20% of these losses will be insured, about 80% uninsured. And so that means that philanthropy, other people like coming out of pocket, some help from the government, there'll be a number of ways people will catch up, but we're quite confident that Houston will rebuild, the Gulf area will rebuild in the same way in our judgment at the Fed. The Florida region will rebuild. Texas has been, just last comment about Texas, the story of Texas over the last number of years is a migration of people and firms. So you'd think the oil business, which we'll talk about a little bit later, very significant business. It's now about 8% of the state's GDP. That surprises a lot of people that it's not higher. But the reason it's not higher is not that the business hasn't solidified, and obviously we've got the Permian Basin and we're a very substantial producer. It's that Texas population in the last 10 years has gone from about 22.5 million to about 28 million people, and we're continuing north. Migration of people and firms, and that trend will continue. As Mark knows from our previous discussion, I'm much more worried about the population trends than the rest of the United States, but Texas is winning that battle. I'm worried about the rest of the country, but the future and the prospects for Houston and Texas in the years ahead, we think are very bright, mainly because the most important thing a state can have or a city can have is population. And we've got good population growth heavily because of migration. I wish the trends in the rest of the country were that positive. They're not, and we'll talk about that in a moment.
So yeah, one of my favorite things that I do here at Stanford is I teach Econ 1. Yeah. And one of the things that we cover in Econ 1 earlier, like last year around this time, was the drop in energy prices. Yeah. And it's truly massive, and at some level, you would think it would have some pretty disruptive effects in the Texas economy. And so is it your sense, obviously the positive population trend has to some extent offset this?
It has. But even with that, just to go back, in 2014, the energy business before the decline was about 13% of the state's GDP. So we've gone from 13% of GDP to 8% of GDP. Okay?
And that's a price change. That's driven.
That's a heavily price change. And we've recovered some. got as low as 6-7%. It's now rebounded about 8%. But here's where I think we are now in the energy business. So global supply demand, which is what I look at first and foremost, is about 96 million barrels a day, okay? And the United States consumes about 19 million, and we produce in the United States about 9.6, 9.7 million barrels a day will be what we produce in 2017. All right, so the issue has been the following. OPEC obviously usually exerts price discipline. They were very concerned about the shale boom, and so they allowed production to run, supply to run substantially. The oversupply that caused this price decline wasn't as much as you might think. Maybe we were out of balance by 500,000 million barrels a day, but it was enough to cause a substantial decline in the price. And U.S. production, our estimate, got as low as 8.6 million barrels a day. We went from about 9.6 to 8.6. Very painful cuts in the United States. Even with those cuts, global supply still went up because those cuts were more than offset by supply increases in OPEC, Russia, and other oil-producing nations, so that it's not that oil supply has gone down. It hasn't, even though it felt like it here because the cuts were so painful. It's that just the rate of growth in supply has slowed somewhat. And then in December of last year, OPEC said, okay, we actually think we're concerned about this, and they announced about 1.8 million barrels a day of cuts, okay, which they pretty well complied with. The frustrating part for them, so 14, 15, we cut, they increased more than offset our cuts. Okay, in 2017, they cut 1.8 million. U.S. production is now rebounded back to 9.6, 9.7, and there have been production increases in places like Libya and others where there had been some reductions. So it's been very frustrating for OPEC in that these cuts have not produced quite the price response that they had hoped for, although we're ranging between now $45 and $55 million a barrel. Our own judgment at the Dallas Fed is, for the next few years, I would call it a fragile equilibrium, okay? We expect that demand will continue to grow globally, 1.3, 1.5 million barrels a day. We continue to expect substantially OPEC will continue to adhere to these cuts. But what will happen is when the price gets to the upper end of the range, 45 to 55, you'll see increased shale production in the U.S. When it gets to the low end, you'll see a decreased production, and we're watching that. So it's a little bit of a regulator. We think that volatility within a band will go on for a few years. If you look out 3 to 5 years, though, because shale has a very fast decline curve, and the big oil companies have not been spending on long life capital projects, in my own judgment, when we get out 5 years more from now, I think you're likely to see a price risk to the upside because the fact we haven't had these long life projects. Shale will continue to grow, but might not be enough to keep up with demand growth of about 1.3 to 1.5 million barrels a day. So the business is stabilized. Some days you'll turn on the TV and they'll say, prices are spiking to the upside, and some days you'll turn on the TV and they'll be plunging. The truth is, I think shale will serve to be kind of a price regulator in here, not perfect, but I think you'll see volatility within a range. But I would say going out 5 years, you could see price risk to the upside in this industry.
Great. So you've been in Texas now for a couple of years, and you moved to Texas from Massachusetts, my home state. And before that, you were in New York?
New York and Massachusetts, yes.
New York and Massachusetts, right? And here we are in California.
Yes.
And tax policy differs a little bit between New York, Massachusetts, California, and Texas.
Although they have some things in common. Yes, you're right. Those three first states
Those three versus Texas.
That's right.
And so you talked a little bit about the population growth and what's happening with economic development. Can you talk a bit about whether you think tax and other policies in Texas versus other places is is important for those funds.
Let me fill in a few pieces of the puzzle. Okay, so we expect GDP growth in the United States, 2017 or Dallas Fed estimates, that it'll be approximately 2.25% GDP growth. Not spectacular, sluggish by historical standards, but it'll be sufficient to continue to take slack out of the labor market. And if we're not at full employment, in my judgment, we're getting very close to full employment, and we see that in terms of reduced labor slack. There are four big secular drivers. We talked about them in our previous session. Let me just mention what they are that help explain to me why GDP growth has been sluggish. The number one driver to me is aging population in the United States, which translates into slowing workforce growth. GDP is made up of growth in the workforce plus improvements in productivity. Our population is aging. We're not alone, makes you feel better. Almost every advanced economy in the world has got the same problem. Japan and Germany have it worse than we do. But we've got an aging population, slowing workforce growth. And this is going to get worse over the next 10 years, in that we expect the labor participation rate is going to decline further because, again, primarily because of demographics. That's one trend. Second trend, which we'll talk about in a little bit, technology-enabled disruption, which I think we'll get later in the questions, but it sets the stage for tax policy. Technology-enabled disruption, not only technology replacing people, but consumers have much better ability to shop for the lowest price. It limits pricing power of businesses, but more than that, it means for the labor force, if you've got a college education today, you're probably very likely got a very low unemployment rate and high participation rate. You're likely employed and doing well. Some college, a little worse, but still pretty good. If you've got a high school level education in this country or lower, technology-enabled disruption probably means for you that you are getting squeezed out of your job and may in fact be going from a job where you make this much to this much. And without middle skills training or retraining, you're having trouble coping. And we'll come back to that. The other two are globalization, which we'll talk about a bit, and then last is high levels of debt to GDP in the United States, and that I would argue the debt levels in this country are historically high at the government level and unlikely to be sustainable, and the only reason we're not talking about it every day is interest rates are so low. In that context, when we talk about tax policy, I would argue there's a war for people, undeclared war for people in the United States. And that if I've got a heat map I look at in my office, there's a whole substantial number of states in this country that are flat or losing population. Texas, I just mentioned on the positive side, is growing and gaining population, but it's taking it from elsewhere in the country. Detroit didn't, there were financial issues in Detroit, but Detroit primarily went bankrupt because of loss in population. Population is extremely important to growth. And in this country, because of aging demographics, we're losing population. One of the issues, which we talked about before, back to taxes, you talk about high tax, low tax states, there's migration already to low tax states, Florida, Texas. If we pass a tax reform which limits deductibility of state taxes, it's likely to accelerate the migration at a time where we're already fighting among the states for people. So this is going to create strains and is creating strains. But it's in the context of slow and aging population growth and workforce growth, which is why this is creating these strains. If we were going this way, growing population, improving demographics, I don't think this would be as painful. But I think we're at the stage in our demographic cycle where this could be very painful for some states and cause acceleration in migration trends.
And so
when cheering you up, or
yeah, right. It's going to get much better. Okay. So yeah, what do you see as the biggest threat? So the U.S. economy right now, if you look out, I checked the close today. Dow is north of 22,800. It's been a pretty good run for quite a while. Unemployment's low, inflation's low, good set of conditions. We can talk about things like inequality, the skills issues, and so forth. But at a high level, unemployment, inflation, stock market, household balance sheets, and so forth, things are looking pretty good. We've got the demographics. So what do you see as the biggest threat
The biggest
to the
threat
economy?
when I look out to the United States is sluggish growth. And if you follow the debt markets and you look at, I don't know how many of you watch the 10-year Treasury. So some of it is increased global liquidity, but in my judgment, as a person who spent his career in the markets, the number one reason why you're seeing a sluggish 10-year Treasury rate is prospects for future growth are sluggish. And why is that? I think the number one reason is aging population, slow workforce growth. We can do things from a policy point of view to address it, and some of them are controversial. Obviously, improve middle skills training to help close the skills gap, i.e. get more people retrained and back into the workforce. That would help. Immigration, as controversial it is, has to be on the menu because immigrants and their children have made up over half the workforce growth in the United States over the last 20 years. We think that was likely to be higher in the next 20 years. But I think the big issue we should be talking about in this country, yes, regulatory review makes sense. Yes, we're underspent on infrastructure. I think $3 trillion is a good estimate, and we need to spend more on infrastructure. But I think the biggest reason why we are facing some of the sluggish growth challenges we have now is this population issue. We have to find ways to grow the workforce, and make it more productive. And if not, we're going to continue to grow at sluggish rates of growth. And because we're already highly leveraged and the populace is aging, the impact of that is, when I grew up in this economy, dependents were here, workers were here. As we age, dependents are here, workers are here. We, in fact, get more leveraged. We've got to find ways to grow faster. And so the biggest issue facing this country, in my judgment, and probably the developed world, is how to grow. In that context, globalization has been discussed as part of the problem. I actually think it's part of the solution. And we probably attributed job losses to globalization that might have been true 15 years ago are much more likely due to technology-enabled disruption. And if we misdiagnose that, we may actually make policy decisions that cause us to grow more slowly when we have the opportunity actually through trade and other policies to grow faster. And that's a problem for this country. And it wouldn't be if we weren't so highly leveraged. We've got GDP is what services debt. We've got to find ways to grow faster.
Okay, great. So I want to get to monetary policy in a little bit, but before doing that, just maybe we can touch on a little bit the global economy. We've talked a little bit about the U.S. economy and alluded to other countries like Germany and China. So when you look out at the global economy, what seems most striking to you, both in terms of what's been happening and what's on the horizon?
So growth outside the United States, interestingly, helped the U.S. recover from the Great Recession, particularly emerging market growth. Growth outside the U.S. has been sluggish the last few years. I'll set aside China and India, but we know in Europe. This year, interesting, the story of 2017 is global growth has been a pleasant surprise. Europe is doing relatively better, still sluggish rates of growth, but relatively better. And I think the emerging markets have stabilized and are doing relatively better. But in that context, one cautionary note is China, in that the headline rates of growth in China are 6.7, 6.6%. I wish I could tell you that should make us feel good, but I don't actually think it should. One of the ways China has grown at these high rates is to dramatically increase its debt to GDP, either by investing in state-owned enterprises or in infrastructure. And they've invested in state-owned enterprises that already have high levels of overcapacity, steel industry being an example. And so I do think that these global growth rates, while they've been a pleasant surprise in 2017, I think the world is going to have to get used to China not being able to continue this increasing debt to GDP to create more growth. I think the world's going to have to get accustomed to lower levels of growth from China. And that means they're a big percentage now of global growth. I think global growth will be somewhat lower because China's growth will need to float down to a level that's more sustainable. But even with that, one of the positives this year is the global growth has been a little better, and I think that's been one of the things that helped the U.S. grow a little faster this year.
And so do you see China as the biggest threat to global growth when you look outside the U.S.?
I wouldn't call it a threat. I would call it something we need to watch. And
just uncertainty about
the rating agencies have already downgraded China. I think there's a point at when I used to run our Asia business in my business career, and I go to China, try to go to China at least once a year. I just think this level of growth won't be sustainable. And they're managing this transition from being an export-led economy to being a more services-led economy is not going to happen over a year or two. It's going to be over the next 20 years. They put very tight capital controls in order to manage capital outflows. And I think managing this transition will be something central bankers and other business leaders will be watching 5 years from now, 10 years from now, 15 years from now. It will take some time to work through this. So it's something to watch as a potential risk and just something that has to be managed.
Great. So far this year, the Fed has raised rates.
Can I make one other comment? So I mentioned globalization might be an opportunity. What do I mean by that? I mentioned that we're going to need to find a way, although it's controversial, to come to some consensus on immigration, because immigrants are going to have to be part of the equation in growing the workforce. Second thing I would say, a lot's been made of the trade deficit with Mexico. Our analysis, and we do a lot of work on trade at the Dallas Fed, our analysis is that approximately 70% of the imports to the United States from Mexico are intermediate goods, meaning they're part of complex logistics and supply chain relationships that have been developed over the last 10 or 15 years that have allowed U.S. companies to be more competitive, to keep plants here, and to likely grow jobs in the United States that might otherwise be lost to other parts of the world, probably Asia, if we didn't have this trading relationship with Mexico. The trade deficit with China is something is heavily final goods. The trading relationship with Mexico is much more about intermediate goods. 40% of the content of U.S. imports from Mexico is U.S. content. So I actually think these trading relationships have likely improved U.S. competitiveness, allowed us to grow jobs. So when I say globalization can be an opportunity, I think analyzing and diagnosing this relationship with Mexico accurately is very important to future U.S. growth, U.S. competitiveness. It's not enough to grow jobs in the United States. They have to be global competitive in order to sustain. And so the reason I mention this, if we misdiagnose globalization and attribute some of the negatives we're seeing to globalization, when I think today it has more to do with technology-enabled disruption, we're going to make poor policy decisions. And that's why I make sure every time I talk to call this out. We need to segment these issues and make sure we analyze them correctly so we make good policy decisions so we can grow faster.
Right, interesting. So NAFTA, what happens with NAFTA matters.
I mean, yes, and I think renegotiation of NAFTA, that's a healthy thing. I think Mexico has already made a number of concessions conceptually as part of TPP, which obviously isn't going to happen. So there's a basis for this to be worked out, and I think it's in the interest of the United States that it is worked out.
Right. Okay, great. So shifting now a little bit to monetary policy. Yeah. Here you're visiting us from the Fed, and a couple of times so far this year, the Fed has raised interest rates. One of those times was, I don't know, 10 or 12 days after Janet Yellen visited SIEPR, and I don't know if we were the...
I would love to tell you that had something to do with it, but I don't think it did.
Right, probably didn't. But I'm curious, in your thinking, you're on the FOMC, sort of what drove those decisions, and more importantly, looking ahead, what's the calculus on those? Because it's hard to get it just right. Their economy, the inflation, and the various indicators are sending mixed signals.
So here's the balance. And I was a strong advocate of raising the Fed funds rate in March, and I was a strong advocate and voted for raising it in June. Why? We've got a dual mandate at the Fed. One is full employment, and the other is price stability. And we translate price stability to meeting a 2% inflation objective. We'll come back to that one in a second, because that's been a challenge. As I said earlier, I believe we are moving very close to full employment. I don't look just at the headline unemployment rate. I look at a number of other measures. The one I like the best is called U6 in the lingo, which is unemployed plus discouraged workers plus workers who are working part-time for economic reasons who want to work full-time. That number today, by the way, is 8.3%. The pre-recession low was 8.1%. It is not easy to get discouraged workers back into the workforce. If we're not at full employment, I think all through this year we've been moving toward it. That was one of the reasons why I felt it was appropriate to raise the Fed funds rate. We are now, though, now that we've raised it, 100 to 125 basis points. I mentioned the demographic issues. Because potential growth in the U.S., I think, is more muted. We can talk about why and debate that. I personally think for that and several other reasons, the so-called neutral rate. I was in markets for all my career. I never thought about the neutral rate. I didn't even know what it was, okay? But at the Fed, I think about it a lot, is a theoretical rate at which, the Fed funds rate, at which we're neither restrictive or accommodative. In other words, we're at sort of steady state. It is my own judgment. If you go back 10 years, that neutral rate might have been nominal 5% plus or minus. Today, I think the neutral rate is closer to 2.5%, much lower because of some of these secular structural drivers. So at 100 to 125, we're still accommodative at the Fed. We're below the 2.5, just not as accommodative as people might think. And so I've been counseling at this stage to be a little bit more patient and gradual. We are not meeting our 2% inflation target. I think part of that is structural, particularly technology-enabled disruption and to some extent globalization. But I think the cyclical forces are building as we tighten the labor force. So I've said regarding upcoming meetings, I'm open-minded about continuing to remove accommodation in the upcoming meetings. Want to look a little bit more, and we have a couple of months, for example, before the December meeting. I'd like to continue to use that time and understand how the cyclical versus the structural forces are playing out. But I do believe that we should continue along the path of removing accommodation, but we should be doing it patiently and gradually, and I think we can afford to be patient because I don't think economic growth is running away from us for the structural reasons that I just said. And that's why you're seeing the Fed be very gradual, and I think that's the appropriate stance of monetary policy. You've also seen us, though, announce we're going to start running off our $4.5 trillion balance sheet. We had a debate earlier today about whether the latter stages of quantitative easing was 1 or 2 stages too much. Fair enough. But I do think, and I feel strongly, the Fed should begin the process of letting this balance sheet run off. And we should do it also gradually, but I think we need to begin that process, and that's what we announced in September.
Great. So one of the challenges, and this has come up for many years. Mike Boskin in the room knows more about this issue than anyone, is the accurately measuring inflation. It's challenging. And maybe some, especially here in Silicon Valley, argue that it's difficult to adequately capture changes in the quality of goods.
Yeah.
And that makes measuring the price of a fixed basket hard to do because the basket's changing so much of goods that people are consuming.
Yeah.
And so how do you think about that sort of when interpreting inflation data? Do you think this is something that's kind of always been a problem and it's sort of the same today as it was 10 or 20 years ago? Or is it more of a problem today? In other words, maybe inflation is not as subdued, or there may be some biases in it.
So there's a couple things we debate a lot at the Fed. Which one thing I've learned, by the way, I'd say this for leaders generally. What's the most important quality I can have in this job? An openness and a willingness to learn. Saying I don't know is a good thing in this job. Asking questions, seeking advice. And so that's the approach I take. I think that's a sign of strength, not a sign of weakness. But that's true. I used to teach leadership at Harvard. That'd be my number one advice to leaders generally. So in this area, there are 2 areas where I don't know. And I think that's healthy that I'm saying that. One is, why is productivity so muted? Yeah. And second is, why inflation is so muted. And yes, I've looked at a lot of the studies that suggest transfer pricing may be an issue. Gauging quality. I've seen studies that even suggested that the certain products like the iPhone have had an effect on inflation. I'm also sensitive to the fact, and Professor Boskin knows this much better than I do, and you do too, the CPI, we tend at the Fed to look at the PCE data, and without going into the lingo, you should just know what's the difference between CPI and PCE. Mainly the way they treat heavily rents and healthcare expenses. The PCE overweights versus PCE the healthcare expenses and kind of underrates rents. Rents have been going up. Healthcare expense, our inflation actually has been somewhat muted. So the short answer is, and I've heard others say this here, you want to be precise, but you don't want to go overboard and give an error of precision. So if you told me we're nearing full employment, the economy is growing, not spectacular rates, but solid rates, above potential, and inflation rates about 1.5%, if you came in from out of town, you'd say, what's the problem? This sounds pretty good. And the Fed is agonizing because we can't get to 2%. And you'd say, it's not a bad situation. So I think my main approach on inflation is to be open to trying to understand it and not attribute precision to certain measures maybe that aren't naturally there. And I also tend to look at core inflation, which trims out external outliers up and down. And we do that a lot at the Dallas Fed. We use the Dallas trim mean. The productivity issue is related in another one. Productivity, you may have heard, is, I said GDP is made up of growth in the workforce and growth in productivity. Productivity growth has been sluggish. That's another mystery. I have a view and a hypothesis as to why, which is I believe back to disruption, workers, particularly if you have less than a high school education or less, are being disrupted out of their jobs, and their industries are being disrupted. And because we don't have extensive retraining, they're going from a job where they make this much to a job they make this much. And while every industry I work with and I observe is much more productive than it was 10 years ago, the workers that are coming out of the workforce, I believe, are becoming less productive, usually going from maybe manufacturing to service jobs, not getting retrained, and we measure productivity economy-wide. So, but we're continuing to do more work on this and try to understand it.
Okay, so this is going to be my last question, and then I'm going to open it up for the audience. So, I'm curious if you can tell us a little bit about how the FOMC process works.
Sure.
It is, you have these meetings, I think 6 or 8 a year?
8.
8 per year. But there's, stuff that happens in between those
Lots.
meetings. It's not like you just show up like, okay, what's new?
I don't.
So can you talk a bit about how you prepare for those meetings and what transpires there?
Okay, so there are 12 reserve banks in the United States. Okay, Dallas is the 11th district. Nothing fancy. We number them, and we're K. So that's the 11th letter in the alphabet. If you look at a dollar bill, by the way, you're going to see one of those letters is on the bill based on what district it was issued. So those 12 banks, along with the governors, there's supposed to be 7 governors. Right now, they're actually down to, I guess we're back to 4. Randy Quarles just got confirmed. There are 4 governors. There's supposed to be 7. We sit around a table in D.C. 8 times a year. The presidents get together a lot because we're working on overseeing payments in the United States and technology and the budget, a lot of other things. But we sit formally in D.C. I have an assigned seat. It's a long table, like a giant dining room table, okay? I have an assigned seat at the head of the table. St. Louis sits on my left. First thing I asked naturally when I got there is, why does Dallas have this seat? No one has an answer. It's been this way for decades. No one remembers when that wasn't Dallas's seat. Okay, fine. We show up in D.C. Usually I show up either Sunday night or Monday morning. On Monday we do committee meetings because we're all together and we're talking about supervision or other issues facing the Fed. Tuesday is a formal meeting where each of us around the table, Janet Yellen goes last, talk for about 10 minutes and give our assessment of the economic conditions in our district, the country, and the world. We each talk for about 10 minutes. That's day 1. We go have dinner together. Day 2, we each go around the table the same way. Each 10 minutes, Janet Yellen goes last, where we each give our views on monetary policy and our recommendation, okay? By this point in the meeting, we pretty well know what's going to happen. And in the last 13 seconds of the meeting, we vote, okay? And that vote, we don't send it to someone to ratify it, it's done, okay? And then at 2 o'clock Eastern time, approximately, it gets publicly disseminated, and if it's a quarterly meeting, Janet Yellen will do a press conference. And I spend Well, I intensively spend about 2 weeks before every FOMC preparing. The truth is, I'm preparing all the time, including today here at Stanford, where I'm going around the table and asking people's views. I never lose an opportunity. I talk to probably 30 CEOs a month easily. We do surveys of small business. We do service sector surveys, manufacturing surveys. We've got our boards, regional boards, and just in my district, and then the Dallas Fed board, where I'm picking their brains on what's going on. I'm talking to all of our economists, and we do intensive preparation. So when I show up in DC, I'm ready, but I'm always trying to think about, in addition to the other things I do in supervision and overseeing a lot of processes and payment systems, et cetera, always trying to understand the economy. And I never miss an opportunity, including when I'm talking to a cab driver, you name it, asking about what's going on and trying to figure out why. But that's what we do at the FOMC.
And there's probably some variation between the 12 regions about how things are going.
Yeah, although there's probably a lot of similarities. Every region does its own surveys, and every Fed president really goes hard between meetings to try to make sure he or she is prepared.
Okay, great. All right, well, I'd like to open it up now for questions from all of you. So I'm looking around, and I have more questions. I have questions.
No, they'll have
David,
questions.
David, here we go. Yeah.
Here you go, David.
Right here.
So Rob, I know you said that on balance, you think that we should be removing monetary stimulus at this point and making some changes. But
Patiently and gradually, yeah.
Right. But my question is, given the declining growth of M2 and given the adjustment that the Fed in Dallas just did on the PCE deflator,
Right.
I'm just wondering what you're seeing that you're not telling us.
So here's the issue, and I'll go particularly. So I think you're referring on PC. We're running below our 2% inflation objective. Well, I'm not sure about that actually. So the core inflation measure got as high as 1.9. It got as low as 1.5. I think you will likely see that continue. If I thought that was going to continue to decline, but I don't actually think that's going to happen. I think you're going to see it ultimately strengthen as we tighten the labor force. Here's the issue. This is a risk management balance now, and this is why I've been saying I want to be patient and I want to assess more information. On the one hand, we're growing at 2.25%. We're taking more slack out of the labor force. Historically, when that's happened, and we get to this low level of labor slack, inflation pressures build, and if the Fed has waited too long, we get behind the curve and we tend to play catch up. It's that catch up that tends to cause a recession. So I'm very mindful of that. I also believe being accommodative is not free. It can distort markets, it can create imbalances, it hurts savers. So there's cost to being this accommodative. So that's on the one hand. On the other hand, as I said, I think out-year growth prospects in this country are sluggish. So I don't think the economy is running away from us. I'd like to see it run away from us. And it depends on what policy decisions we make, but I think it's sluggish. And two, we're not meeting our inflation target, I think mainly because of structural forces. So what I'm trying to judge is, I want to be patient, I want to wait. What I want to avoid, though, is waiting so long that we get such a tight labor force that inflation pressures begin to overwhelm these structural headwinds, and we find, now I see inflation, I waited too long. This is a little bit like heading into an intersection. You don't hit the brakes when you see red. As you approach it, let's ease off the accelerator a little bit. Removing accommodation doesn't mean hitting the brakes, it just means easing off the accelerator. We're still not restrictive, okay? And I'm just trying to balance, and this is a judgment call. I want to avoid having to hit the brakes hard and play catch up, because our experience is that's highly likely historically we've seen to cause a recession. And that's the judgment you see that we're struggling with.
Great. Next question, right here. And then Jeanette.
Picking up on your comments about the importance of labor force growth and use 6, I'd love to hear how you and your colleagues think about the ranks on disability, and also whether you have developed any personal perspective outside of your role on the Fed about universal basic income as a solution to perhaps reengaging some of those workers.
Okay, so let me take the second one first. There's lots been said, gee, with all this disruption and it's accelerating, is there going to be enough work to do? And I'll give you my own view, but this is my personal view. I actually am not as worried about that as other people. Disruption's been going on for a long time, and yet everywhere I go, can't find enough workers. Half of small businesses saying, I can't fill these skilled jobs. We are very inventive and innovative, finding new goods and services and ways to produce. And so even though disruption is accelerating, I still believe, I'd like to see us improve early childhood literacy and college readiness and middle skills training, but I believe there'll be enough jobs in the years ahead. So I don't think I would advocate going so far as universal income, like as, we need a safety net, but I think there'll be enough jobs, I believe, in the years ahead because of the inventiveness of the U.S. workforce. And the first part you asked about is disability and others. So I am alarmed and concerned by studies I've seen that have analyzed discouraged workers and prime-age workers. And what I find is it's highly correlated, again, to lower levels of educational attainment. So that's clear. But we've noticed that you also see excess drug usage, other trends in that discouraged group that's very concerning, high levels of disability. The number one, we do surveys in our district, and we ask the question, what's the number one skill that you're having trouble finding? When you say you can't find skilled workers, what's the number one skill you can't find? And I thought this was, I didn't take it seriously when I realized, but after several surveys, number one skill that's been cited by employers, ability to show up on time and work a full week. It's very concerning. So there's something fundamental going on out there that we should be worried about as a country. Disability is a part of it, drug use is another part of it, and I think it's something we should be working hard to try to understand better.
Jeanette. Oh, oops, sorry.
I'll add on to that question, more on the policy side. You've been a very forceful voice here tonight, not surprisingly, on this whole labor force issue. And in California, I think we know a lot about that. A lot of the growth in California in the 1990s was double the population growth, the national average. How does the Fed get this into the policy debate in Washington, D.C.? Because obviously that does not seem to be informing the policy debate at present.
So I'll give you my own attitude on this, and I think it's shared probably by other people around the table, but I'll speak with my own view. My job, I believe, and our job at the Dallas Fed is to do excellent research and disseminate it broadly without regard any elected official, any official or anyone in the economy who wants to see it. And then my job is to try to sort of amplify it every time I speak. And then I spend a lot of time meeting with elected officials and talking about these issues. And I think I'm not alone. A lot of other people around the table are doing that. And so we plan to continue doing it. By the way, we also try to play a leadership role in our district, but we're not alone. We just did a workforce development conference with the whole system in Austin. I also believe our job is to play a leadership role in our district to convene groups to take action on this and not wait for someone else to do it. Early childhood literacy, let's get business leaders. Remember, I have a nonprofit background, in terms of venture philanthropy. Let's get business leaders, nonprofits, schools. Let's work together. Let's convene. Let's create programs for early childhood literacy and middle skills, et cetera. But I think we are working hard to disseminate this. So you may say, well, why isn't it working? If I say these, because there are people who disagree. My job is to, in an apolitical way, disseminate this, talk about it, not be fearful about political influence, political pressure, and be right down the middle and try to disseminate these views. And that's what I intend to do and will continue doing, but I'm not alone. I think a number of other people around the table are trying to do the same thing.
Okay. Ellen, yeah, I'm not sure who. Jackie.
I was very interested by your comments on how the debt is only unconcerning because of the low levels of interest rates. So even though that isn't part of the dual mandate of the Fed, is the level of government debt something you consider when discussing interest rate rises?
Well, I think about it. So one thing I've learned at the Fed, and I've talked about this, there are cyclical, and we talked about this at lunch today, there are cyclical forces and there are structural forces. I'm not a trained economist, I'm a business person. Business people, and a lot of business people in this room, tend to look at running your business. I look at drivers, okay? So quarterly profits are a result of drivers. Okay, so I like to look at drivers because I want to run a business where we're going to do better. And so there's probably some debate about the right way around the table to think about high levels of debt to GDP. My own view is it is a headwind and potentially a future headwind for economic growth, and we should be very concerned about it. And that may mean controversial, again, sense of the entitlement reform, other actions, find ways to grow faster so that we can get this debt, more in shape, because I do believe it will be a headwind for future economic growth. So all these drivers are a factor in my thinking when I think about monetary policy. Yes, that's for me. I do think about them.
A question right here, Peter. Right over here first, and then over here. Yeah.
Thanks. I have a financial conditions question. Fed's been raising interest rates. However, that touches the economy through a whole constellation of interest rates, high yield, investment grade, mortgage rates, and so on. As somebody who spends a lot of time in markets, we've noticed that as the Fed's raised rates, many interest rates have actually fallen and financial conditions have actually eased. And in fact, borrowing has accelerated. Investment grade issued $1.5 trillion this year, which actually contributes to the stock of GDP.
Right.
How does that market reaction factor into the Fed's decision to continue raising interest rates and change financial conditions?
Yeah, so there's a few pieces of that, so let me take them in pieces. Number one, I actually been very concerned. The Fed sets the Fed funds rate, right? And we know the balance sheet, quantitative easing had more effect on the curve, but we're now unwinding that. So the Fed funds rate is the rate we set. I also look at the 2-year, the 5-year, the 10-year, the 30-year. And I've, along with you, have noted that as the Fed has raised rates, the 10-year has actually backed down. That's a little ominous, cautionary for me. I don't view that as necessarily an easing. I view that as a comment on future economic growth. And what I don't want to see us do is raise rates so fast we create an inverted yield curve, because history has shown an inverted yield curve has tended to be precursor to recession. So back to the gradual patient, watching the 10-year hang around 230 something, I'm very cognizant of it because it limits the ability of the Fed to raise rates too rapidly, and certainly has an effect on the limits to what level we can get to if you want to avoid a flat to inverted yield curve. That's number one. Number two, secondly, macroprudential policy is a very critical element of what we do. Okay, so I'm a strong believer that we need regulatory relief on the one hand for small, mid-sized banks. I think they don't pose a systemic risk. They do a lot of small business lending in our country. They serve local communities. It's absolutely true in the state of Texas. I want to see relief. I feel differently, though, and I worked at one big bank. I was on the board of another. You would think I believe strongly we need strong macroprudential policies, annual stress testing, very rigorous testing. Doesn't mean we can't relook at Dodd-Frank and the Volcker Rule, but we need strong macroprudential policy, because what I'm watching, excessive valuation, in my judgment alone, is not necessarily going to create a terrible risk. If we had a correction in the market, I think we could manage it. What I'm worried about is associated debt buildup, which you referred to, or credit default swaps were a good example, or other imbalances that are tough to unwind. And I think strong macroprudential policy, gives me some comfort that as the Fed is gradual and patient, if we have strong regulatory policies, it makes me more comfortable that we can tamp down on excess debt buildup, like we did, by the way. We were concerned about a year and a half ago about excess mortgage lending, and we tamped it down. And that, I think, that kind of ability is useful and gives us more operating flexibility on monetary policy. And so I've been a strong advocate. We ought to be careful to keep very tough. I think the country is best served by strong regulatory policies for the big banks. And I don't think it's hurting the U.S. economy. Small, mid-sized banks, that I am concerned about. I think we need regulatory relief there.
I think we've got one more. Sorry, we have last question here. Sorry.
What changes in tax policy do you think would do the most to improve longer-term economic growth in the country?
So I'm as a central banker, and given a lot of people feel the Fed has already gotten a little too big for its britches and overstepped its bounds on size of our balance sheet and other things, I'm always a little careful to talk conceptually but not get too far into details for fear of overstepping. But I'll answer it with that caveat. What I'm looking for is actions that help improve sustainable GDP growth. Key word being sustainable. So I'll start at the extreme. A tax cut financed by increasing the deficit strikes me, will give us a short-term bump, we'll go right back down, except we'll have more debt to GDP. That doesn't meet the test. I think there are other aspects, though, being discussed. Maybe the corporate tax rate, maybe enhanced investment incentives, other aspects of the tax code. The trick is you want to do it in a way that doesn't unduly increase debt to GDP because we're already at very high levels. But I think there are some aspects being discussed that I think could help lead to sustainable GDP growth. I just caution if it's just a tax cut financed by increased debt, I'm concerned it won't actually increase sustainable growth. It may actually impede it.
Great. Okay, well, with that, please join me in thanking Rob Kaplan for coming to see.
Thank you, Mark.
Great.